Right. So, chap, these are question. This is. Oops, sorry. Let me just come back here again. This is question 16 to 20. So let's look at the scenarios here. So we see here that we have a number of non-current assets, a review taking place, and this is really a question of dealing with a number of IFRSs actually, but dealing with property and fair value. And it says here that he's holding a historical cost, and this is becoming increasingly irrelevant. So if you remember, I'm sure you remember the cost concept. You can IAS PPE, the IAS for PPE 16 allows you to fair value and revalue if it is, of course, relevant. Again, this is kind of going back to the conceptual framework of relevance and faithful representation. So relevance really is looking at the actual asset itself and the cash flows, and if you believe the rentals in the future will be more, well, and if you present value those increased rentals as a result of the economic environment, then it does mean that the asset should be much higher, represented at a higher amount, which is what leads to the revaluation process. So it says it would like to hold assets at fair value, but has never previously revalued any of the assets. So that's the first thing. So let's look at that first, and then we'll look at the next one, because the questions kind of work along. So in relation to this, the director's beliefs, which of the following is not a deficiency? Not a deficiency. So let's look at some of the deficiencies of historical cost in times of rising prices. I'm sure you can already imagine what they are. So you have buildings, if you like, and then prices are rising, but you're keeping yours at historical cost. So definitely asset values are understated. It's definitely a certainty there. If you keep them at historical cost, you depreciate, so your depreciation values are much lower than if you had revalued them, and hence you'd have had higher depreciation. So you have lower depreciation. So in effect, but the assets are generating higher revenue, but then you have lower depreciation. So yes, profits are overstated. And what you would have is, of course, you'd have on your balance sheet a mixture of other things that are at current value and at historical cost, so like inventory and other financial instruments, if you do have any. So you do have a mix where, so it's all a bit disjointed. So the one thing, though, to be fair, I mean, these are all deficiencies. The one thing, though, that is certain is that items are less, the fact that it says here items are less verifiable as they happened years ago, well, that's not true. We can verify them, because we have the invoice, we have the transactions there in place. So that's probably one of the certain things about the historical cost concept. So let's look here. This next talks about IFRS 13. So this was a standard written on its own to just deal in general with fair value issues, right? So a lot of fair value things going on, but you just had this one standard written to kind of manage all of those. And so it breaks up information. So it's important you know this. I'm sure you will look at it level 1, level 2, level 3. Level 1 being your kind of your purest market, open market information, if you like. You can go, you literally open the newspaper, everyone has access to it at the same time, and it isn't everyone's gaining access to it at the same time. It's pretty much your best form of trying to understand what is the market price of something, the fairest, if you like, value, you could argue. So here we are. Level 1 inputs are likely to be used without adjustment, most definitely, because they are market at the market rate. Coming back to D as well, looking at D as well. Level 1 inputs comprise quoted prices in active markets, so very much active markets, identical assets and liabilities at the reporting period. So very much markets that are active, things are going on. So we can be sure that people are exchanging products at this rate. So A and D definitely. Level 2 inputs may include quoted prices for similar but not identical. So we're beginning to move away from the purity or the reliability of level 1 into sort of, well, we don't have as many we don't have as many identical assets, but we have slightly similar. We can we can play around with things. Level 3, this is definitely wrong. Level 3 is when we just don't have any external information. The assets are unique, and we almost have to look at the individual cash flows of that business we're looking at, and then present value those cash flows to kind of work out what the value of that asset is. It's not the best, but at least we have some cash flow, something to work with. So level 3 inputs are based on the best information available to market participants. So that's just not true, and therefore regarded as providing the most reliable evidence, and that's just not true. Okay, great. So B is the flawed answer there. Okay, great. So this is about interest. This is about interest. So this is an important question, and I'm just going to kind of flip in between two screens so you can see. If I can do the double entry so you can see what's going on. So here it says here that the key it says Vendo took out a loan, a 10 million loan at 9% on the 1st of January for the construction of a new building. So let me go here, come over here. So here we are. So they took out a loan of 10 million, if you like, at 9%. That's the interest rate that's going to be paid. So I'm just going to put here interest, and I'm going to put here capitalized interest through income statement, if you like. And that's kind of the issue here. The question here is, can we capitalize? As you can imagine, the question here is how much of that interest can we capitalize and how much of it just goes through the income statement. And they're saying the interest that relates to the building of, if this loan was taken out for building something, well, you can capitalize that interest, which in a way allows us to kind of save costs going through the income statement and therefore delay payments and things like that. So what do we have now? It says here, due to delays, construction did not begin until the 1st of March. So we had 2 months where we're just taking out this loan and we would just have been paying interest. So let's look at the scenario there. So let me just get that up again. So what are we saying? We have 2 months here where we will be paying interest at 9% on the 10 million, but also I'm going to say 2 over 12, so in effect, so you can see what's going on here. So in effect, this interest will not go through, will not be capitalized. We have to pay it. Let me just calculate that very quickly. So there we are, 2 divided by 12, which is that, times 0.09, which is that, times 10 million, which is 0.15. So here I have 0.15 interest that will go through. I'm just going to pretend and create back. I'm going to pretend we're paying it straight away, 0.15. So this can't be capitalized because we're not actually building anything at the time. Okay, so let me go back to the question. Then it says that you actually, due to delays, and the construction does begin on the 1st of March and completed on the 1st of November. So 1st of March to the 1st of November is 8 months. So let's look at that. Now let's go back here. So now I have 8 months. So 8 over 12 times 9% times 10 million. So I have 8 divided by 12 equal to this times 0.09 times 10 million. And here I have 600,000. So I have 0.6 million here that I can capitalize. This I can capitalize. Now, the problem here, of course, is here. Let's look at this. Is here where you now have a scenario where it says, as all the funds weren't needed immediately, 2 million was invested in 5% of bonds from the 1st of January to the 30th of April. There's no problem. You can borrow money and invest it and do what you like. But the question is, what can we capitalize? If you borrow some of it to capitalize it, well, then you can't be kind of having your cake and eating it. So let me show you what this means. So we have 2 million, 1st of Jan to the 30th of April. So let's go back here. 2 million at 5%. Okay, so for the first 2 months, if you like, this really is a case of there's nothing to do with capitalization. For the first 2 months, just change my pen color. For the first 2 months, in effect, what we really have here is a scenario where you have invested some of this money, and at 5% for the first 2 months, because there's no capitalization pretty much in this same scenario, we have 5%, 0.05 times 2 times 2 over 12 times 2 divided by 12, which is 0.016. So in effect, you made some income, if you like. So you had 0.016, if you like 0.016, some type of, if you like, some income on those bonds. Now, again, as you can imagine, it would be interesting if you could then also include the other income for the next 2 months whilst you were capitalizing the interest as well. So in effect, when I say having your cake and eating it, you are able to recognize income and also capitalize interest. That doesn't make any sense. That's not the point. So the whole idea is what you now have to do is for the next 2 months, if you remember it was for 4 months you did this. Yes, so you had, this is the January, February months that I just talked about, which go through the income statement, but the March and April will go through. So I know it's 2 months, so I know that's 0.16 as well. So that in effect 0.16. So yes, it's coming to the bank, but that will reduce the amount of capitalized interest that you have, that you can capitalize. And in effect, therefore, your carry down figure that you can capitalize is therefore 0.583. So and there you are. So that's what I need. That's my answer. So let's go back here to the question. So you can see here, question 18, the answer is 583.333. And that's that. Okay, great. Okay, let's quickly move on to 19. What is the balance on the revaluation surplus? So another interesting one here. So we know, so let's look at what, I can do this up here. So in effect, what's happened here is, it says that on the 1st of Jan, they've revalued all the properties, the majority have increased in value, giving a total net increase. So we don't net this thing. What we have here is some of the assets have fallen in value, some have increased in value. If it's fallen in value, it goes through the income statement straight away. So in effect, I'm going to pretend I had 2 buildings, in effect, included two of these items had fallen by 2 million. So I'm going to pretend that I only had 2 issues. So one went up by 26 and one went down by 2. The one that went down by 2 goes straight to the income statement and as an expense. And in effect, I only have 26 in my revaluation reserve. That's it. Then it says that you make an annual transfer from the revaluation surplus for excess depreciation. So they had a remaining life of 10 years. And as you can imagine, therefore, I will then say, well, 26 divided by 10, which is 2.6. And I will release 2.6 from here every single year over the life of that asset against the depreciation charge based on the new revaluation figure, which therefore will bring me a carry down figure here of 23.4 year for that year. And so, and that's what the question is asking in effect. It says, what is the balance of the revaluation? So it's 23.4. So here we are. So which if either of the following statements regarding the revaluation of assets are correct? Statement 1: if the revaluation model is used, all non-current assets must be revalued. So it's the key red herring here is properties. All properties must be revalued. There are a range of non-current assets, as you can imagine, that a business can have that are apart from properties. So we don't revalue all the non-current assets. It almost quite misleading, but that's the point of the question, to sort of trip you a little. So it's just the properties that need to be revalued. We can't cherry pick, if you like. It's an old term. But you can't cherry pick your properties. You have to revalue all the properties. And statement 2, vendor must perform a revaluation of all the properties every 3 years. No, regular revaluation to make it relevant, if you like. And you could argue, but balance it with cost, which typically means that you should probably do this every single year. So neither statement is correct. So that's question 16 to 20.